Hi everyone, welcome back to Corporate Decoder, the place where we decode the corporate world. Today we're diving into TruGolf Holdings' latest quarterly report, a document so exciting it might just make you want to take up golf, or maybe just stick to mini golf. Who knows what this report holds. This filing paints a picture of a company navigating a challenging course, dealing with accumulated losses, compliance issues, and debt, but with the promise of continued growth. We'll look at their financials, their struggles with NASDAQ, and what it all means for TruGolf's future. Before we get started, if you appreciate these corporate deep dives, hit that subscribe button. Also, join our Discord community in the description below. Let's start with the balance sheet, which is like a snapshot of the company's assets and liabilities at a specific point in time. We'll look at March 31st, 2025 compared to the end of the previous year. First up, cash and cash equivalents, the lifeblood of any company. They've got about $10, $, $5, $5 at the end of the previous year. Inventory also saw a significant increase, going from $239 million. This could mean they're expecting more sales, or it could also mean they're having trouble moving their products. We will see about that soon. Overall, their total assets increased from $17.1 million to $27 million, which sounds positive. However, their liabilities also went up, with total current liabilities jumping from $15.80 and $18.2 million. This is also reflected as a slight decrease in the total stockholders deficit, going from about negative $4.64 million to negative $4.57 million. It's still negative territory. Now let's check out the income statement, where we can see if their sales match the inventory increase and how they're actually making money or not. Revenue increased slightly to $5.4 million in the same period last year. Nothing too crazy. Their cost of revenue actually decreased, which is good news, showing they might be getting better at managing their production costs. However, selling, general, and administrative expenses went up significantly. This means they're spending a lot more on things like salaries, marketing, and other overhead costs. The result is that they ended up with a net loss of $27 million, which is worse than the $1.3 million loss they had last year. So they sold more but lost more, not a great sign. The loss per share also doubled from $0.09 to $0.22, showing that they are diluting the stock in addition to losing more money, which is not a great combo. Alright, let's move on to the statement of cash flows, where we see how well they can actually move money around. Their operating activities, which are the core of their business, actually used up $449,000 in cash, whereas last year it provided $27 million. They also used cash for investing, buying equipment, and capitalizing software. Luckily, financing activities like taking out loans brought in $2.5 million. This is the only reason they were able to somewhat stay afloat. Overall, they ended with more cash than they started with, a total of about $12.6 million. Now let's check out the notes. It's where companies put all the extra details that you won't see in the financials. Else the report mentions they create indoor golf software and hardware and are focused on both the residential and commercial golf simulation industries. The company was originally known as Deep Medicine Acquisition Corp. This means they did a SPAC merger and changed their name, which is usually a red flag, to be honest. They also created a new subsidiary to focus on franchising, aiming to sell franchises that use their simulators, showing diversification. Things are not looking good for them with the NASDAQ, as they are already under a warning that their stock didn't meet the minimum bid price of $1. This is also combined with a warning from their market value being too low. The report admits that they expect to incur further losses and will need additional funds, so they expect they will need to find new funds. These are the rules they follow to make these financial statements. Nothing too interesting here, as the report notes. It's the normal gap. If this was messed up, then things would be bad. In this section, we learn the estimated loss rate is based on historical experience with specific customers, understanding of the company's current economic circumstances, reasonable and supportable forecasts, and the company's judgment as to the likelihood of ultimate payment based upon available data, meaning they seem to be extra careful in their report estimations. The company has investments in corporate fixed income and government securities. They got out of marketable securities from previous years, and their gains are more or less a rounding error. This is a table that just has values of what they own, not interesting. Here we see that in 2024, the company used a PITE to pay off some debt. They did pay off debt with it, which is better than if they just used it for operations, but it's still a loan, not actual progress. Here it just describes the type of stocks, both class A and B, that they have, and confirms they do not have preferred stock. Now, putting it all together, here's my take. TruGolf is definitely facing some headwinds. Their cash flow from operations is negative, and they're relying on financing to stay afloat. The Nasdaq compliance issues are also a major concern. It is clear that despite the revenue growth that they show, and I believe their spending is all over the place and they are not in control of keeping spending in check, however, they have made great improvements to their software and are actually used in the industry. And to be honest, it might be their only chance to fix up the company. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.